Markets are rallying. We've got euphoria all over again. It feels like 2021. Carvana's up. Your meme stocks are up. You've got Meta pushing up higher. You've got the ARKs moving up higher. You've got tech moving up higher. Crypto moving up higher. Stock market is also moving up higher. Does that mean the economy is safe, right? Well, if the stock market's going up, that means there's no recession, or if there is a recession, it's a soft landing. It should be all safe all of a sudden, right? Because the stock market's up. So stock market's up, so you should be doing fine, right? And if you're investing in the stock market and you feel everything's fine, then guess what? You'll probably go out and spend here and there because, hey, look, we're out of the bear market. Things are fine all of a sudden. Well, the stock market sure may be a leading indicator, and the stock market may be a leading indicator to tell you about how the economy may be, but the stock market may not be right all the time, right? Many times we have seen the stock market crash in history, especially when we've got rate cuts, because something bigger was coming out of that situation in 2008, when you look at 2008, when you look at 2001, and other recessions as well. Now, before we start, my name is Daniel. You're watching InfoVest. We talk about macro news, economics, macroeconomics, the financial markets as well. If you like content like this, subscribe, hit the like button, the bell icon to be notified on the next video. And if you want to learn more about how markets work from a macro point of view, we've got courses on that, and you can subscribe and learn through sending us an email on our website at www.infovesting.com and find out more details there on the different courses we have. Now, let's get back into it. When you look at the economic data versus the stock market, right? The stock market's on euphoria. And you look at the economic data, ADP, the jobs number, basically came in weak. Yes, we had ISM numbers that came in as well. ISM manufacturing came in slightly weaker than expected. That does suggest that, we're probably in a recession right now. However, the employment component, when you look at the ISM employment, it moved above 50, which signals that employment is strong, which is pretty good. Same with the JOLTS number. You had the JOLTS number come in stronger than expected. So again, no problem there. So growth is deteriorating. There's signs of recession. However, the labor market seems to be strong. Now, we're going to get non-farm payrolls tomorrow. Very important jobs data that's going to come out Friday. And it's going to be interesting to see how the wages component and the employment data comes out and how the markets are going to react. Now, why is the markets going up? I did explain this in my previous video that I did yesterday, that Jerome Powell basically did the unthinkable and completely shrugged off the question when a journalist asked him about financial conditions. And financial conditions, that's a code word for the stock market. So when someone asks that, hey, financial conditions are easing, are you worried about that? Jerome Powell's like, financial conditions have tightened. We've tightened the most. So I'm not really worried about these short-term moves in financial conditions. And that just gave huge euphoria in the markets. Markets went up. You got the meme stocks going up, the Carvanas, the ARKs, the cryptos, the monkey coins, the Doge coins, the whatever coins that, people like to buy. And we see the markets are moving back up again. Does that mean, we're safe? Does that mean economy's fine? Does that mean, hey, bear market's over? Or did the markets take Powell's message the wrong way? Or why did Powell shrug it off? When you look back in December, he was completely hard, and he did say that financial conditions, remember, financial conditions, aka stock market, the rally, the easing we're seeing in financial conditions was unwarranted. Basically sounding very hawkish, saying that stock market shouldn't be going up. It's creating easing conditions. In August of last year, Powell also came out during Jackson Hole sounded very hawkish, very aggressive. What happened all of a sudden? Now we start to see Powell start to sound a little dovish. Did he make a mistake? Well, we'll find out. We'll find out in the coming days if Powell finds it necessary to come out and say, hey, the markets are reading it wrong. I'm not, I am worried about the financial conditions and I'm going to maybe do something about it, right? If that happens, then obviously you'll see a reversal in the equity markets. But if he doesn't, then guess what? Sure, the stock market can continue to rally, and go up higher until something happens in the economy, until we see months later the true signs of the tightening that we've done last year. The true signs that we'll probably see, in the summer or the end of the year. The true signs of bringing rates from 0 to almost 5%. The pain of that. Because Powell was saying, pain is coming in August. In August, during the Jackson Hole, he was saying the inflation is too high, and the unfortunate cost of high inflation is that it's going to bring pain to households and businesses. Now he's sounding completely different. What does that signal? Well, signaling for, again, the stock market and the bond market that, hey, a pause is coming very soon. Maybe some rate cuts. We'll see what happens. The bond market is pricing in 50 basis point rate hikes by the end of the year. 50 basis point rate hike by the end of the year doesn't necessarily mean that there is a recession, a very ugly recession. Right? If we have a severe recession, a hard landing, we would have to do more than 50 basis point rate hike. So the market is expecting that, growth is going to deteriorate this year for sure. We'll be in a recession for sure, but it's probably going to be a soft landing. That's what the markets are pricing in. The bond market hasn't priced in, hard landing's coming. We got to cut rates even further. And if that starts to be the narrative, then you will see the bond market start to rally. And then probably, we'll see what stocks do, right? Stocks could move up on the narrative that rate cuts are coming until maybe they realize that either one, inflation's not coming down. Two, maybe the Fed's going to do more than expected and didn't like how the markets are reacting. Or three, the equity markets figure out that they're not getting the rate cuts this year as they were anticipating. Or four, something really breaks in the economy, something worse off happens, which basically throws this whole euphoria, throws everyone off. Definitely you want to be careful on this rally. Sure, you can make money as a short-term swing, medium-term swing, couple of day trades here. I'm not saying that you can't. You can definitely ride the wave, but I'm talking about a year from now or two when the data starts to reflect the true effects, when the economy starts to show the true effects of all the rate hikes we've done in 2022 and also in the beginning of this year. And we'll probably see it maybe September, maybe summer of this year, probably most likely end of this year and heading into 2024. So this euphoria, this everything that's happening right now, markets are fine, economy's fine, recession is over, nothing's wrong, everything's good again. Well, let's see how long it lasts. Sure, could we see all-time highs? Could we see S&P 500 break the highs of last year? Could they make a new high? Could we see 5,000 in S&P 500? Sure, 100%. Could we have a soft landing? Sure, it's all a probabilities game. But let's not get confused that CPI and inflation is coming down because the growth is deteriorating. The jobs data and ADP shows weakness. Yes, ISM shows strength. We're going to see what NFP is. But as growth deteriorates, as there's more layoffs, it's showing signs that, we are seeing that the economy is slowing down. And we're just seeing the early effects of all of this since we've been tightening last year, and we're seeing the effects now. We still got 11 more months in this year to see the full true effects. So enjoy while you can, and again, just be careful when you're out there in the markets. And we'll see what Powell has to say in the next FOMC meeting, especially when he comes out with the projections, and especially after we get more data like CPI, more growth data, and we'll see how that plays out when it comes to the markets. Anyways, guys, I'm Daniel again. You're watching Infovest. If you like this content, subscribe, hit the like button, the bell icon to be notified on the next video. Comment below what you think about this rally. Do you think we're going to hit all-time highs? Do you think the bear market's over? Or we started into a bull market? And let me know what you guys think. See you guys around. Cheers. Bye.